guys, my name is Michael Glass from michaelglass.com, and I want to thank you guys for continuing to watch our video series on how to become a better trader. Before we begin, we always like to talk about our disclaimers. Any symbols that you see today should not be inferred as a trader recommendation. No matter what form of investing you choose, stock, forex, futures, options, they all have a level of risk associated with them. You can lose your money. The strategies that we show today are for educational purposes only. Future results are not guaranteed. And most importantly, any investment decision you make is solely your own responsibility. Trade at your own risk. So, as I said, I want to thank you guys for watching our 5-part video series on how to become a better trader. We've been focused on a couple things. Our first video, we talked about, do you know what time it is? And this is really talking about the context of the market. You have to understand the context, the forecast of the market. And you also have to know the optimum times of each day that you should be trading. Technically speaking, it's all about an introduction to technical indicators. Chart patterns are all about different chart patterns that we can use to be successful in trading. And this video, video number 4, is Stop in the Name of Money. We're going to talk about risk management and how to utilize stops. And the last video in this series is called Mental Fitness for Traders. Now, you can see little annotations popping up. If you didn't see any of the other videos, just click on the annotation, and they'll take you back to see those videos. But right now, let's stop in the name of money. Now, as I said, stop is all about risk management. And this is definitely where I see traders go from being profitable traders to being losing traders. Or a better way of saying, the reason they're not profitable is because they're incorrectly placing their stops. And I've said throughout this video series, sometimes they're placing their stops correctly, but based upon the strategies that they're trading. However, they're not placing the stop properly based upon their bank account. And thus, when they start taking a little heat, when they start taking a little back action there, their emotions take in. And we all know, at least for me, I've never made money when I've made emotional trades. So, understanding how to place stops, understand risk management, understand capital management is very key. Very key. I've helped traders not really change their trading, but change their stops and change their ability to understand how they should trade their money. And that alone changed them from being losing traders to profit traders, or specifically being inconsistent traders to being consistent traders, because they're now trading within themselves. They're trading who they are and their risk tolerance. That's so key to being a successful trader. And you got to kick off with the golden rule of trading. Cut your losses and let your winners run. And so many traders hold on to their losses and cut their winners. Oh, I got a point. I got to get out. I'm just so happy to make a point. I'm so happy to make a point in the futures. Meanwhile, they're taking 5-point stop outs because they're hoping and they're praying. Oh, 1 tick in their favor. Woohoo! 3 ticks against them. Oh, man. 1 tick in their favor. Woohoo! 3 ticks against them. So now we're, 4 ticks down? Off of 2 ticks up. Then it goes 8 ticks against them, you know? And so, and they get this tick for tick back, and then they get into the Lord Jesus. Lord, whoever you pray to, Lord Jesus, if I can just break even and get me out, I promise never to do this again. Oh, Lord Jesus, if I could just lose a point, I promise never to do it again. Again, emotional trading. And then what happens? As soon as you get stopped out, boop, the stock market does exactly what you thought it was going to do. Incorrectly placing your stops, not letting your winners run, and instead letting your losers run is definitely a reason why many traders are inconsistent and they're not profitable. What exactly is a stop? Well, it's basically a mechanical way of triggering a sale. A way to either get into a position or a way to get out of a position. When a stock or a future or oil or a commodity, whatever investment vehicle you're choosing, whenever it hits a certain price, then an order is executed. And it doesn't matter how briefly it gets to that. Now, that's on a market order. If it's a market order, as soon as it hits the price, you go in. Now, if it's a limit order, now there's a little difference there. Now you actually have to wait to actually be filled. So you could hit that price, but not get into the position because you have a limit order, meaning that you only want to get in at this price. And remember, the movement of stocks, the movement of any commodity, futures, is all about the connecting of buyers and sellers. So just because a investment vehicle hits a price does not mean you have to be filled. And again, if you're using a market order, there's no guarantee you actually get filled at the price of the stop that you have entered. So you got to be careful about that also, especially I'm definitely like to use stops on very liquid vehicles so that you don't get too much whipsaw, you don't get too much movement. Some stocks when you have high volatility or you have it's not heavily traded, you can put a market order and get a really what we call a really bad fill. So a stop is just a mechanical way of entering or exiting a trade, a position. Why should we use them? Well, first and foremost, it's to limit your loss when a market moves against you. But these stops can also be used to initiate trade. And so a better way of putting this is that stops automate your trading. I'm a very, very, very big proponent of taking emotions out of trading. When I began to just put orders in and walk away, I became much more profitable. And when I became more profitable, I became more comfortable. And then, it all started to fall in. However, when I was entering positions and sitting there, and then I'm like, I'm going to move this up. And I know there are very successful traders who can move stops up. I prefer to have it mechanically, based upon an algorithm. Price moves this far, move my stop down. I prefer that because I know myself. That doesn't make me a good trader. It doesn't make me a bad trader. It makes me a comfortable trader. It makes me a peaceful trader because I know who I am as a trader, and therefore I can be successful trading as me and not as someone else. So stops are a way to save our money, again, cut our losses, because based upon our risk management strategy, some people say 2-to-1, some people say 3-to-1, some people say 4-to-1, meaning whatever your target is, if I'm going to enter at 1, I want the target. And again, and we'll talk about this in the video series. If you purchase the video series, you have to know where you want to get out. A reason people lose money is they get into positions, but they don't know where to get out. And so the market moves up to resistance. They didn't know it was resistance. They didn't realize that was their first target. And then it comes back. And then now they're in a loser. They turn a winner into a loser because they didn't have any targets. You can't just get into a trade. Before you get into a trade, before you put in stops, before you put in your orders, you've got to know, here's my first target, here's my second target, here's my targets. And so, again, these stops allow us to get into trades, but once we know where our target is, then we say, well, if my target is 4, then I want my stop to be 1. Or, if I'm going to get in at 2, I'm going to have a stop at 1 because I want a 2-to-1 ratio. I want to make 2 points compared to the 1 that I'm risking. Some people do 3-to-1. Some people do 4-to-1. Long-term traders definitely do much longer risk to reward ratio. You'll see some day traders do 1-to-1, especially in the futures market. Then some of them may not admit it, but some of them do 1-to-1 because they're in and out of positions so quickly they feel comfortable with that. And again, I'm not saying yay or nay to that. I'm saying yes to who you feel comfortable as a trader. So by automating my position and understanding that my stop is based upon my risk to reward ratio, how much money am I willing to risk in order to reach my target? Similarly, I can also use stops to say, well, if I want to get into 2, I'm going to go ahead and put in my limit order as a stop, a buy stop or a sell stop to initiate a position because, again, I don't want to be sitting around. I don't want to be thinking about it. I want this to be automated. That's me. And so since I just talked about it, let's talk about the different types of stops. We got a buy stop. That is when a certain stock, futures, certain commodity reaches certain price level, I want to buy. Now again, buy stop does not necessarily always mean you're initiating a position. You can have a buy stop to close out a position. If you're going short, that buy stop target could be to close out a short position. A sell stop is when a certain stock, a certain commodity hits a certain price. I want to sell, I want to short. So it's a sell stop. Again, sell stops could be to close out a long position, or they could be initiating a short position. And then our trailing stop is in that risk management is when we are moving the stop. As the market moves in our favor, the stop will trail behind it to lock in profits. Again, cut our losses, let our winners run. So many people, as I said before, not recognizing where their targets are, lose out on 2 points, 1 point, whatever it may be, and then the market turns against them. If you had a trailing stop moving up with the market, at least you could have got a break even. At least you could have locked in some profit. But because you did it, and now the market's going against you, and you get into that emotional tick for tick battle, which usually ends in a losing position. Common mistakes of stops. First and foremost, putting them too tight. And again, this has a lot to do with when you're trading a position that requires a 4-point stop and you only put in 1 point. So it's not that the strategy is wrong, it's the way you're trading the strategy is wrong. Another thing is not being aware of context. So many people put their stops in front of support, before resistance, and the market comes back, stops them out, and then it hits support, and it goes in the right positions. We like to call it hide your stops. Hide your stops behind support and resistance, because then if it breaks through support and resistance, it will get me out anyway. But when you put your stops ahead of that, you're allowing the market to say, okay, thank you. Now that I hit support, I'm going to go in the direction that you want. Also, when you context, do you know what time it is? First of all, why you're in the market when there's big, market news anyway. But if you are, you have to be in context of knowing that the news will get you stopped up quickly. I knew a guy who liked to trade the jobs report number, and he put in these stops to get into position at this price if the market goes long, and get into this position and the market goes short. Please laugh with me for a quick moment, because I have my hands up to indicate long and short. I don't know if you care about that, but to me, I'm laughing about that. But anyway, what happened was, because he had these two stops in, you know what the market did? It's a news event. The market got really, really crazy, and it went up, filled him long, boop, stopped him short. He lost several $1,000s and was mad. And it's like, well, if you're going to allow yourself to be in a volatile market like news, you have to be prepared to take losses. You have to be prepared to deal with the volatility of the market. You have to be comfortable with the strategy that you're trading. And of course, one of the most important things is forgetting that they exist. Sometimes people have these stops in, especially if they're manually putting them in, and then they may close out, with a market order, or close their position, and forget about they have a stop in, and the market comes back and fills them. It's like, oh, I forgot I had that stop in. If you hit close out, and you don't say cancel all positions, those stops are still out there. So you have to be very, very careful. So again, when we think about, common mistakes and are you asking me stopped out, you have to be concerned about market conditions. Remember, news overrides everything. Support and resistance. Are you not protecting your stops by putting yourself above resistance, below support when you're placing your stops? And of course, understanding the context of the day. If it's why are you doing buy stops to initiate positions to go long on a responsive consolidating day? Similarly, vice versa on the downside. When you're initiating positions and you're putting them in, you have to be aware of the type of day that it is. As I just said, when we're doing responsive trading, we have to think about hiding our stops above and below support and resistance. When we're initiating position, we have to think about the market, and when we're trending, so if the market is, the 30-minute breakout trade is a perfect example of an initiating position. So you can put your stop at a certain price level based upon if the market breaks that half-hour high or low. And this is all about defining your edge. How you utilize stops, how you manage your money, your risk, is how you define your edge. It's how you become a successful trader. It's how you understand that there are opportunities in the market, and you're placing your stops in the right places to use the right strategies to take advantage of that opportunity that the market plays in. Context of the market. Again, high probability trading. And I know you guys are saying, why are you doing these same slides at the end of each of these videos? Because this is what it's all about. This is what it's about to be a successful trader. Understanding the playing field. Where are the big boys? Are you trading with the big boys? Or are you trading against the big boys? Are you trading when the odds in your favor? Are you trading when the market is going against you? Can you tell the difference between if this is going to be a high risk trade or low risk trade? You can take it no matter what, but you have to know, again, if you're going to trade the jobs report or the jobless claims, that's a high risk trade. It can make you a lot of money. You can lose money, but be aware of the strategies that you're using and make sure that you're comfortable with the risk. In the end, it doesn't matter all these strategies, all these videos that you're watching, all these indicators and rooms that you're in. If you're afraid to pull the trigger, it doesn't make a difference. And that's what it's all about. That's why I put together these resources. You can find us on YouTube, Facebook, and Twitter. Move Up with Mike, or Are You Financially Literate? And our video series, again, if you want to really learn more about stops, you want to learn about all the different things we've been talking about in this video series, got a great video series for you covering the basics, helping you develop a trading plan, and even giving you some great setups that you can use to become a successful trader. And I'm throwing in a bonus half hour with me to make sure you can implement it based upon you. Again, as I said, people go out and get all these strategies, but they don't know how to trade them for you. I want to make sure if you watch these videos that you can trade it for you. Or you can skip all the videos and contact me directly on just doing a direct one-on-one trading session. All right, guys, so we got one more video. The mental fitness of trading, the most overlooked aspect of trading, psychology of trading. All right, guys, I'll see you next time.